Hello everyone, thank you for joining me. Welcome back. The US banking sector can no longer hide that it is facing substantial challenges, and some small to mid-sized financial institutions may not be able to keep their doors open much longer. In addition to a massive wall of debt, $1.7 trillion worth of commercial real estate debt that is projected to mature from 2024 to 2026 over the course of the next couple of years, banks have been increasing their reserves to cover anticipated losses as household debt skyrockets and consumer delinquencies are on the rise. If you have been a subscriber of mine for a while, you may recall that I post frequent updates on the banking sector, and as a former bank auditor myself, this is something that I take great interest in, especially nowadays with the volume of red flags increasing and less than joyful, sorry, I had to use that very popular word these days, less than joyful forecasts moving forward. The latest news is very concerning. Top U.S. regional banks are seeking consolidations. Remember, I said multiple times over the course of the past several months that small to mid-sized banks, due to their extremely high, north of 70% exposure to commercial real estate, they are in deep trouble. Regional banks typically have assets between $10 billion to $100 billion. At this time, in the United States, there are over 4,000 individual banks, and many of them will be merged and consolidated. Regional bank mergers have ticked up this year and are expected to increase due to lenders seeking stronger balance sheets reportedly. In other words, regional banks are dealing with liquidity issues, and they would much rather consolidate now than risk it all. If there is an event that causes panic, and we know that the next several months will be quite interesting to say the least, or if this uncertainty persists, as we know the labor market is not doing very well, consumer debt is skyrocketing, so things are not exactly going well, to be completely honest. So far, there have been 38 consolidation deals this year fully completed, compared to only 29 deals during the same period last year. Furthermore, according to Reuters, more than 2/3 of lenders in the KBW Regional Banking Index have a greater than 50% chance of being acquired over the next 12 months, according to StarMine M&A data. With that being said, we should expect to see an increase in bank consolidations. So far this year, the biggest deals have been up to $2 billion. South State Corp purchased Independent Bank Group, and UMB Financial Corp acquired Heartland Financial. Those were the top two so far. Given where the United States economy is at this time, bank consolidations shouldn't be necessarily viewed as a negative trend, in my opinion. I think they are better than the alternative. However, having said that, I do want to say that when companies merge, they seek synergies, meaning that they may lay people off, they may close branches. So these mergers and acquisitions will definitely have an impact on depositors, and they may have a quite negative impact if it means that your banking institution is not going to be near you anymore, and the nearest branch will be miles and miles away. So that may happen as well. In general, there are three main reasons that would drive bank consolidations. The first one is the regulatory environment, and this is the direct function of our government, of course. People don't realize how much control the government has over the banking industry. The banking industry is one of the most heavily regulated businesses in the entire world. This isn't necessarily bad, of course, since the goal was initially to protect depositors and to protect borrowers. However, that cannot be said regarding all government regulatory requirements these days. Back in 2023, bankers knew quite well that there would be more consolidations in the near future, simply because they knew that recent regulatory changes increased the level of capital that banks with at least $100 billion of assets must sustain to guard against possible losses. U.S. bank supervisors proposed rules last summer that would further tighten regulations for large banks in an effort to incorporate elements of the international governance framework known as Basel III that was agreed upon after the 2008 financial crisis. Small to mid-sized lenders were not subjected to Basel III requirements per se. However, with that being said, the 2008 financial crisis did lead to government regulations that further tightened the government's grip over those small regional banks. This is one of those cases where it's not clear, of course, whether the medicine is actually worse than the disease itself. Increasing requirements and government involvement rarely leads to positive outcomes. I think we can agree on that. The second driver of bank consolidations is an improvement in efficiencies, which makes banks more profitable. So, of course, shareholders seek profits, and this is precisely what's driving consolidations and M&A discussions. The third reason is something that sounds quite concerning: digital capabilities and digital transformations. The third reason reminds me of the CBDC and the fact that greater control is enabled by fewer entities to control. So naturally, there would need to be a substantial consolidation process prior to the launch of the digital central bank currency. Now, I'm not saying with certainty that this is necessarily where things are heading, but it does make you question whether this is just a precursor to more substantial changes, which, as we know very well, are clearly on the horizon. A recent report alluded to the plan to decrease the number of banking institutions in the United States as investments in digital technologies ramp up. The need to increasing tax spend has further driven the desire for scale, and we expect consolidations to pick back up as cyclical headwinds abate. The banking industry has always benefited from scale, as the act of acquiring another bank is simply much quicker and easier than attempting to poach customers from a competitor. However, investments in technology digitization require significant capital and resources. With the ever-increasing cost of these investments, scale matters more than ever given the need to spread these higher fixed costs across a wider base. So it is business as usual for big banks, for the banking industry in general, and for you, consumers, it is a matter of figuring out how it may impact you and what you need to do to adjust to a growing risk. Therefore, we likely should not be surprised by the uptick in bank consolidations. It is part of a broader agenda that also goes hand in hand with substantial investments in AI, in tokenized assets. You might recall that Chase and the Bank of America already offer conversion of your traditional deposits into digital versions. So this is the trend that is only beginning to gain momentum. Nobody is really discussing this, unfortunately. There must be a reason for that, but it will impact every single one of us one way or another. I will certainly keep you updated. Please consider joining my community on Patreon and on Locals, as well as following me on other social media channels. I typically link all of my platforms in the description right below this video, and I certainly hope to see you there as well. Thank you very much for watching. Thank you for your time. Like, subscribe, and share, and I will see you back here tomorrow. Enjoy the rest of your day. Bye for now.